Hey, welcome everybody to Tax Planning for Homeowners and Real Estate Investors. Here's our host, Janice Fernando. She's helping families make the right move through HomeSmart Realty West. She's a real estate agent extraordinaire in San Diego County. How you doing tonight, Janice?
I'm doing great. How are you doing, Jesse?
Good, good. It's exciting times. You know, the real estate market is so high right now.
Incredible.
My God, your clients and everybody, right? And everybody has a lot of questions of like, what do I do? What do I do? Right? So I'm really appreciative that you're putting this together tonight. All right. Well, hey guys, just if you don't know me, my name is Jesse Lipscomb. I am an enrolled agent and investment advisor. I specialize in tax planning for real estate agents and real estate investors. And we are talking tonight about selling your home, as well as tax deferral strategies, given the current environment. So, hey, Janice, is it a good idea to sell my home today?
Yes, it is, Jesse. It's an Uber seller market right now.
I like
amazing.
That. Well, and you know, love Zillow or hate Zillow, it doesn't matter. This is just good data. You know, this is just saying, in San Diego County, from San Diego property, East Lake, Carlsbad, Escondido, you bought your house in 2012, you've made some money. You know,
very nice.
But what's really interesting is if you look at this imaginary line right here, look at how much property values have gone up since 2020. That is just crazy, right?
We don't know when it'll end.
I've heard of people, you know, paying $50,000 over asking price.
No, Jesse, 300,000 above asking.
Oh my goodness.
Certain areas.
That's crazy.
Certain areas. That's nuts.
That is nuts. But hey, they're trying to get a piece of the pie, right? Well,
yep.
So let's say that you're selling your house. I think, Janice, most everybody has heard, even if they don't know what it means, they've heard of, well, you know, if you got this 2 to 5 year thing and 500,000 or 250,000 exclusion, you know, what they're talking about is IRS Section 121. And for most people selling their primary residence, this is one of the best tax benefits there are for homeownership. It's huge. But there are several gotchas with it. Some are good gotchas. Some are great, actually. And we're going to talk about those in a minute. And some are really bad. So we just have to know, the rules. And that's what we're going to talk about here real briefly. So, you know, I normally would always gloss over the exemptions. And the reason I would do that is that they didn't come up very much. But with COVID, it's happening all the time. One of the exemptions is for our military folks. If you're called up to qualified active duty, qualified extended duty, the definition of it is 90 days of continuous active duty service, and you're at least 50 miles away from the property, you've got a great benefit. You can stop the clock on that 2 to 5 years for up to 10 years. So just super easy math. Let's say that 2014, you bought a property and you lived in that property. You're stationed here in San Diego. You bought the property here. It's your house. 2014, 2015, 2016. You're there for 2 years. And then you get orders to I don't know where. But wherever that is 50 miles away. Okay? Well, that's 2016 and we're in 2021. That's 5 years. So clearly you haven't lived in the property the last 5 years. But military extended duty, we can say, well, no problem. That's within 10 years. We can stop the clock. We can go back and treat it as if you never left. And the only caveat there is in those last 5 years, they were renting out the property. We're going to have to lower their purchase price by any depreciation that they took. But that's not a big deal, right? That's stop the clock, a huge benefit for military. Work-related move, you had to work to take another job. It's at least 50 miles away. You had to move at least 50 miles to take care of yourself or a loved one, family member. The commonality there is all 50 miles. okay? What we're seeing the most right now are the unforeseeable events. So this is whether it's death or divorce or twins. Hey, to think that divorce isn't on the rise because of COVID, that's happening, you know?
That's unfortunate.
Um,
Twins, that's fun.
Twins, kind of fun. Uh,
Yeah.
Unemployment eligibility is really interesting. 2020 saw a lot of people get unemployment that never had before. But regardless of whether you took unemployment, if you became unable because of a change of employment status, maybe you went from full-time to part-time, you become unable to pay your basic household living expenses and anything reasonably necessary, you know, you're in a situation where that unforeseen event may help you sell right now, even if you haven't been in the property for more than 2 years. So let's talk about this. Is a real example, and I can, you know, I can change the numbers from 400,000 to 500,000 to 700,000 to 800,000. It really doesn't matter. If you bought a house in 2020 and you had to sell in 2021 because you lost your job because of COVID, or you just lost your job, in this situation, you got a $100,000 gain, but you've only been in that house for 12 months. You got to, it's 2 years, man, 2 to 5 years. So if you've only been there 12 months, what do? Well, this is the unforeseen events, unforeseeable events, exemption, excuse me. All you do is you take the number of months that you've owned it, divided by 24 months, which is 2 years. And in this situation, 12 of 24 is 50%. So if you have a $100,000 gain and you're entitled to half of your exclusion, which would be $250,000 or $125,000, you just compare those numbers. Guess what? You can sell and you don't have any taxes due. And I think we were talking about this earlier. Like, what a wonderful benefit tax-wise, actually, for going through something bad. You know what I mean? Like, you didn't ask for a job. You didn't, you know, you didn't ask to participate in any of these unforeseeable events. But if that is your situation, you know, we just got to figure it out. If you've been there 12 months, or God, if you're 18 months, what is that? 75%, right? If you're married, that all of a sudden, those are some pretty big numbers. Speaking of big numbers, non-qualified use, it results into a lot of negatives. And we need to know that the rules changed in 2008. Why or what? Well, it used to be you could 1031 and 1031 and keep on exchanging your rental properties, and then all of a sudden get to a point and say, hey, I want to move back in. And you could move back in, and if you've been there for at least 2 years, you could use that $500,000 exclusion if you're married. But January 1st of 2009, the rules changed for you. And the bottom line is now there's a proportionality test of use, which will dramatically lower your exclusion. And for goodness sake, don't ever move back into a rental property for 2 years and then think about selling it. Just don't ever do that. You know, if you love your rental and you want to live in it because it's your dream home, great, but otherwise don't do it. Here's what I'm talking about. Janice, this is the absolute easiest example to show non-qualified use. You bought the house for $100,000 in 2010. You never lived there. You didn't even think about living there. You made it a rental from the get-go. For 8 years, it was a rental. I want to sell this property. Let's move back in. And now all of a sudden, it's worth $600,000. So you got 5 years primary residence, 600,000 minus 100. You get a $500,000 gain. You're married. You're cooking with gas, but not now, because non-qualified use, and you can look this up, Irish Publication 523, I think page 15, page 16, whatever. It's going to say, listen, you got to take, if you've owned this property as a rental since 2008, 2010 in this case, you've got to figure out how many years did you own it and how many years did you rent it? Oh, 8 years on 10, that's 80%. That means that of the $500,000 gain, 80% of it, or $400,000, is not eligible for exclusion. to say it positively, you can only protect $100,000 of the gain. Okay. So what does that mean? That means you messed up your life for 2 years. You move back into a rental, and you still end up owing over $100,000 in long-term capital gains and depreciation recapture, and I don't know what. Okay. So
yeah. This is a really important point, Jesse, because not many people know that the law changed in 2008.
Yeah. It's mind-boggling. I mean, this is actually, as a real estate agent, you guys do a great job of giving real estate advice, and every once in a while they'll give, oh, you know what you ought to do? I heard that you can live in the house for 2 or 5 years. Why don't you move back into your rental? Don't do that, right? If your real estate agent tells you
Don't do that.
Call Janice, because that's wrong. Don't do it.
Yep.
Okay? Don't do it. All right. All right. So what happens if you do have this rental that you didn't move into, and you want to sell it? Well, you do a 1031 exchange. You can do a trade-up strategy. This is really awesome and really frustrating right now. It's really awesome because historically 1031 exchanges have been a tool to help you accumulate more wealth through real estate by basically playing Monopoly, right? You buy one red one and you get another one, you just keep on going up and up and up until you got your hotel. The rules are, you got 45 days to identify the new property and 180 days to close. Given our seller's market, where you potentially will have offers 50,000, 100,000, 300,000 over asking price, it puts a lot of undue stress on a 1031 exchange. Okay, I've seen a lot of people exchanging highly appreciated yet old California real estate to brand new properties in the Midwest. Okay.
I was just going to ask you that. So it's nationwide. Well, this is a federal 1031, right?
So it's interesting. A 1031 exchange, that IRC 1031, it's federal, but California has to have its take on it. So in the event that you sell your highly appreciated California real estate and you go out of state, which is a fun thing to do, just make sure that your tax person always files California Form 3840. It's informational only. It doesn't mean anything. You're not going to pay any taxes on it. However, you got to do this until you either die, donate the new property to charity, or you decide to pay taxes on it. Think about that. And you think I'm kidding. You think I'm making this up. I am not making it up. Take the FTB's word for it. This is a screenshot of the FTB's website. And it even says, hey, if you don't file this form, we will issue a notice of proposed assessment, which basically tells, say they're going to assess taxes. And you know they're going to hit you high because you bought that property for $100,000 and you sold it when it was $1 million, and then you bought 4 $250,000 properties in Texas, okay? And they're going to hit you up for taxes on that $1 million gain. So
unless you file this every year.
That's it. You just got to file it every year. Okay. So the 1031 exchange is an awesome strategy to accumulate wealth. But if you ever find yourself in a situation where you're saying, I'm tired of toilets, tenants, and trash, and I want to sell my rental, but I'm going to get hammered in capital gains. If you ever hear that, well, there's hope. And it's an old-timey strategy with a new twist. I'll explain. So just like we've talked about Section 121, the 2 5-year, $250,000, $500,000 exclusion on your primary residence. And we've talked about Section 1031, which is the exchange for one real estate investment to another. You've got the old 453, which is the installment sale. Okay. Now there's goods and bads with 453, but before we say no, let's hear it out. Okay. In an installment sale, oftentimes referred to as a seller carry, the key to it is you don't pay taxes unless you receive money. Okay. Well, let's say you have a $500,000 gain. $500,000 gain. Married, a lot of that money, if not all that money, should be taxed at 15%. Some of it may be taxed as high as 20%, and some of that money may even hit an additional 3.8% Medicare surtax. So just federally, some of that money may be taxed as high as 23.8% plus 25% depreciation recapture plus whatever your state bracket is, typically at least 9.3 or 10.3. All of a sudden, you can see that a lot of your gains are being eaten up. But what if, instead of getting a lump sum of $500,000, what if you got $50,000 a year for 10 years? Oh, that means you might find yourself in the 0% capital gains bracket. Now, this is better than it looks, because for a married couple, this is based on taxable income of $80,000, which means even if they don't own their own home, they get $24,800 or $25,000 just showing up to the party as a new standard deduction. So now you could earn as much as $105,000. Let's say that up until the time you sold the property, it was just your Social Security, your spouse's Social Security, and the rental. Take away the rental income, replace that with $50,000 a year of income. You know what? It's real likely that most of that 50 grand will now be taxed at 0%. It's interesting, right?
Mm-hmm.
And so let's go back and look at what's bad about the Section 453. There are two really bad things about it, but it's okay. Let's know the good and the bad. The bad, number one, that everybody thinks of is, oh man, what if they don't pay? Then I got to foreclose on them, right? Because it's true, you're the bank. If they don't pay you, you got to foreclose on them, and that's a hassle for somebody that's tired of toilet tenants and trash. They don't want the hassle. And I've actually met people that have done installment sales where they were hoping they were going to be able to foreclose. Like they were getting paid and then they get to get the property back, right? But I know most people, they don't want that headache. But the other threat's worse. And the other threat is, well, what happens when this buyer, because interest rates are so low, they refinance out of your loan for cheaper money, or they come into an inheritance. So, 2 or 3 years down the road, you're just a note holder, man. And if they come in and they pay off your loan, guess what? You just receive that money, ergo, you've got to pay the taxes. Okay? So there are two big negatives with the traditional Section 453 installment sale. However, it's still a good strategy in certain circumstances. We've improved upon it, though, by a trademark strategy called the Deferred Sales Trust. Now, the Deferred Sales Trust, it combines an installment sale with a real sale, well, a traditional sale. So our attorney team creates a business trust called the Deferred Sales Trust. You, the seller, sell the property to the trust for a note. Okay? That note is the installment sale. All of this is contingent upon the trust selling it to an outside buyer for cash. Now, we don't care. We don't care if the outside buyer has cash or credit or a combination thereof. It doesn't matter. That this is just a traditional sale. And what happens at close of escrow? Literally, physically, the cash is in the bank of the trust. And you are the major note holder of the holdings of the trust, whose whole job is to make payments to you. So all of a sudden, we've avoided the major challenges of default and prepayment. And so let's just look. This works really well in a lot of different ways. I've done several several deferred sales trusts in this scenario. there was like a neighborhood in Lemon Grove for a while that they all bought the houses for $100,000. They all sold them for $400,000. They had this $300,000 gain. And after paying $100,000 in taxes at closing, if they reinvested the proceeds at 3%, by the way, good luck. CD rates are like 1%, but whatever. They would get $750 a month of income. And that's just on a taxable typical sale. Through the deferred sales trust, we were able to eliminate the taxes due at closing, small legal fee, and then instead of giving them just interest to live off of, we did fully amortized principal and interest payments over 12 years. Well, look at the difference. That's $2,500 a month more money. But by doing this, we kept the principal portion of the payments right here in the 0% tax bracket. So all of a sudden, they're able to get rid of the toilets, the tents, and the trash, and get the one thing that practically everybody needs, whether they're retired or not. And what is that? Income, right? In this case, it becomes mailbox money. It's just consistent, predictable income that you can live on. And I'll tell you this much. A lot of people out there that are real estate investors were frustrated during COVID. And why? Because of the foreclosure moratorium. Can you imagine being 70 years old and having a rental and having you need this money to live on? And I'm going back for no particular good reason, but you're 70 years old, you got a rental property, you've got, I don't know, $1,000, $1,500 a month net income. I know the real income's like $2,500 to $3,000. You got property taxes and maintenance and I don't know what. So you're living on like $1,500 a month, and then all of a sudden this crazy cold comes around that closes the economy, and the government says, "Oh yeah, don't worry about it. You don't have to make your rent payments either." What?
Right. Yeah, that's right.
And so the deferred sales trust comes to the rescue. You get to sell the property at today's higher values and exchange that asset for an income stream. You're not missing.
So you would only put the taxable gain portion, like after you took out the 500, like say for a married couple, they have a $500,000 exclusion.
Great question. Whereas deferred sales trusts are typically positioned for investment properties, you can use this in conjunction with the sale of the primary residence. However, you have to realize that gains come out first. Super easy math. Super easy math. You bought the property for $500,000. Okay, $500,000 personal residence exclusion puts you at $1 million, right? But you bought the property for $500,000 in 2002. It's now worth $2 million. You've got $1 million gain over and above the Section 121 exclusion. So what do? Well, here you have two options. You just pay the taxes on it. By the way, talking about a heart attack, it's your primary residence, and you're going to pay basically 30% tax on that $1 million. You're going to lose about $300,000, and it's just math. We're just going to look. We're going to look at the table. Most of that's going to be at 20% plus 3.8. So that's 23.8%. Plus you're going to add in, basically 10% California. What is that? That's 33, 34%. So you might end up losing or owing $350,000 in taxes on the sale of your own primary residence. With the deferred sales trust, we can set up that payment. We can set those payments up over 10 years, 15 years, 20 years even, to try to keep those payments low. And I know a lot of people will want to, sell their existing property and maybe downsize to another one. Well, earlier, Janice and I did a video on Prop 19. Here's a situation where you could sell your $2 million home, use a deferred sales trust to defer the taxes. Let's say we're doing it even over 10 years. Well, most lenders will give you credit for recurring income if you can prove that it's going to last at least 3 years. It's a 10-year note, fully amortized. You can then use that income to help the income, not the cash, the income, to qualify for another home and use Prop 19 to transfer your property tax basis. This is a powerful strategy that can be utilized, whether it's an investment property or a primary. It's nice compared to a 1031 exchange because we're not in the rush to make a buying decision once we sell our primary. And
so does this have to be completed before close of escrow?
Well, even
or
before,
created?
way before that. Like, so my attorney team will tell the seller that, listen, if you go in and you get a listing agreement and you've removed all the contingencies, you're in a pickle, right? We have to justify the economic substance of this trust. We have to justify that, hey, listen, it was created for the purpose of, of the note, because the trust sells the property to the outside buyer. Right now, not to make people nervous. Listen, you're doing this as a concurrent escrow. Like, you're selling it to the trust is selling to the buyer. It's happening. It's almost like your own living trust where you're taking it in and out of the trust to sell it, right? So it's a smooth operation, but nevertheless, we have to justify that the trust is legitimate, right? Now, the nice thing about the way Campbell Law, which is the law firm that puts this together, the really nice thing about them is that they'll create the deferred sales trust for the seller on contingency, basically. Meaning that if they just sell the house, they just sell it, and they don't implement the deferred sales trust, they don't owe anything. But if they utilize the strategy, then the legal fee, which is 1.5% of the sales price, it just nets out of the equity at close of escrow. Which, I mean, you didn't come out of pocket, that's okay, right? And so you can see here, I'd rather pay, $6,000 in a legal fee than $101,000 in taxes every day of the week, right? So that, Janice, is a quick recap of what's going on tax-wise in the real estate world. If you're selling your house, you have sections 121, 1031, and 453 available. For homeowners, sections 121, where you get that 2 to 5 year exclusion. Beware of the non-qualified use. But hey, if you've got more game than you can handle, section 453 and via a deferred sales trust might be really good. If you've got a rental property and you want to continue accumulating wealth through real estate, you got a 1031 exchange. And if you're tired of toilets, tenants, and trash, you can go to the deferred sales trust, section 453, and convert that asset into an income stream. You guys out there, if you've got any real estate questions, you can call Janice at 858-837-2581, JaniceFernandoHomes.com. For us, it's roadmaptax.com. Janice, thanks so much for putting this together.
Thank you, Jesse. Appreciate it.
Y'all have a great night, and let us know if we can help. Bye.